At just before midnight on August 19, 2026, the United States was hours away from imposing a fresh 50% tariff on $20 billion worth of Canadian goods. Then President Trump announced a last-minute deal to pause the levy. Today, on Thursday, August 20, 2026, the central question is simple: is this a genuine breakthrough, or merely a 3-day reprieve that kicks the crisis down the road? The announcement does not remove the threat. It only delays it while negotiators fight over the same unresolved sectoral tariffs. That difference matters for businesses, investors, and Canadian households. To understand the pause, look at the pattern. In February 2025, Trump delayed a plan to hit Canada and Mexico with 25% tariffs, then imposed a watered-down version the following month. The latest threat is more severe: a 50% tariff on $20 billion of Canadian exports, with a deadline of midnight on August 19, 2026. Canadian negotiators reportedly weighed walking away unless Washington offered a substantial reduction in sectoral tariffs, meaning tariffs aimed at specific industries, especially autos. Hours before the deadline, Trump and Prime Minister Carney spoke, and Trump announced a pause, reportedly for 3 days. But the key terms remain unclear. That is the real story. The announcement is light on detail, and both sides are digging in. Right now, this is not an abstract trade dispute. A 50% levy on $20 billion of goods is not a normal import duty. It is a shock that can rewire supply chains overnight. Canadian exporters, particularly in the automotive sector, face the prospect of sudden cost spikes. American importers would pay those tariffs first, which is why the U.S. Chamber of Commerce has called for constructive talks instead of deadline brinkmanship. Today's pause keeps goods moving, but it also leaves businesses in limbo. No firm can plan long-term around a 3-day promise. For consumers, the longer this drags on, the greater the risk of higher prices on both sides of the border. Even a temporary delay is not cost-free. Uncertainty itself acts as a tax on investment. The near-term outlook hinges on one word: autos. Sources indicate auto tariff levels remain the key sticking point. Canada's strategy appears to be to hold firm for a substantial reduction rather than accept a cosmetic pause. If negotiators cannot settle sectoral tariffs within this 3-day window, the 50% levy returns to the table, possibly as early as this weekend. The pattern from February 2025 shows Washington is willing to use deadlines to extract concessions. But Ottawa's reported willingness to walk away means it will not pay any price for a delay. The most likely next step is more last-minute drama: a partial deal, an auto carve-out, or another extension. Immediate full resolution remains unlikely without published numbers. So what should you take away today? This is not a deal in the true sense. It is a managed pause. The 50% tariff has been delayed, not cancelled. The gap between the two sides remains wide, and the 3-day clock is already running. If you trade, invest, or buy goods that cross the Canada-US border, treat this reprieve as a window, not a verdict. Watch for a formal statement on auto tariffs and any sign Ottawa has accepted a lower sectoral rate. The real signal will be whether the next announcement contains numbers, not just another delay. Until then, the risk is not gone, it is merely postponed.